All right, thanks for having me. So let's get going. We got a short amount of time, and I got a lot of stuff I want to cover with you. If you have questions after the presentation, you got my email address down at the bottom there and the website address. A little bit about myself. I've been doing this a long time. Started delving into the markets in the late 80s. Didn't know anything, maybe like some of you in here. Back in 1994, started a fax newsletter service before the internet really began to evolve. Phone hotlines, eventually chats, chat rooms, live trading, and offices. Had several offices around the country, and the old brick and mortar style of doing things eventually became died, kind of, so to speak, having all of those places, and had an online brokerage firm at one time. So, and been doing this a lot of years. I sold all my old recordings and the old company name back in 2015. That information is still lurking around being sold. Did a lot of trading challenges over the years, went to the Traders Expos. I think they've kind of tended to be software expos virtually, instead of the great expos that they were. Anyway, I haven't been there in a while. And educated a lot of people over the years, hedge fund managers, specialists, prop traders, people like yourselves, of course, and investors. And a lot of my students, and you can see on the website if you go and read about myself, they're pretty well-known people. Well, some of them are well-known people within the industry, so you might be surprised to check that out. So this is myself way back when at the first Traders Expo, before they had money shows and everything else that company does, was just a Traders Expo. And back in the day, all of the online brokerage firms that are vying for your account and saying they're going to teach you technical analysis were telling everybody, stay away from those crazy day traders. You're going to lose all your money. And eventually their light bulb went on and said, hey, this industry is not going away. And, now they're somewhat, they own the industry, spending millions and millions of dollars on advertising to get you to open up an account. So through my journey, I started where I imagine we all do, opening up a software platform and seeing the hundreds of indicators and trying to figure out which one, which settings. The one that you're looking at on the screen is called, if I'm not going to butcher the name, an Ichikumi cloud. Wasn't available back in when I first started out. And this has evolved to the point of, I would say, craziness, of looking at all of these squiggly lines and colors and saying, where are the prices in all of this? So as I did this, and I guess tired of banging my head against the wall and looking like the guy in the middle with all the question marks as to which indicator, which settings, how do I set this all up, which time frames, things move around when I change the time frames, overbought and oversold, and what's a buy and what's a sell. I got to the point where I said, this doesn't work. It doesn't work for me anyway. So as a last ditch effort, before I gave up and went back to what I used to do, I took everything off the charts, including the horizontal lines, and the light bulb moments started to go on as I realized that everything that these indicators were trying to do or interpret and tell me what to do was right on my screen. I just had to look at the price action. Now, I grabbed this out of maybe even the trading platform that I use myself. I use a couple of them, but they all display charts. And I use eSignal for stock trading and chartings, and I use NinjaTrader for futures. And I've had a NinjaTrader account for many, many years, over 15 years, I think. So all of these platforms are great. They all have certain bells and whistles, but they all have indicators. And you have to decide at some point, do you want to have indicators tell you what to do and do the analysis for you, or do you want to do it yourself? It really does get really confusing. And there's only 68 on here. many of these platforms have a couple of hundred or more. And when you start thinking about which ones and changing the settings, which are the right settings or combination of indicators, are they optimized? Your head begins to explode. So what I'm going to teach you today is what I call a thought process. Because when you're looking at prices and you're sitting there doing the analysis, there's a thoughts going through your head. So how do you control these thoughts to be systematic? Well, you need some type of a system of interpretation to decide, are prices going up, down, and sideways, which sounds kind of crazy initially, but you look at a chart and you say, is that going up, down, or sideways? And it's interesting, and you start thinking about the different types of analyses and what you could trade. And there are option traders out there that say you don't even need charts. You can't tell if prices are going up, down, and sideways according to them. So I'm going to show you how to decide if things are going up, down, and sideways. We say price is king. Everything else is secondary. And when candlesticks, we just choose to look at them in a candlestick format because those pictures are easier to see, for me anyway, than a bar chart, and to read their messages. I'll show you how to do simple trend analysis, multiple time frame analysis, look at support and resistance, and everything else. We don't have time to do it, but it's covered in what I teach every day, even in our chat room, what I call the green room. My partner and I do education and real-time trading in there every single day. And all of this is applicable to stocks, options, futures, currencies. It doesn't matter, because whatever you're trading, human beings are pressing the button and they form patterns. Those patterns are what we read, so we call it price pattern analysis or trading. So candlesticks, there are all of these different names for candlesticks. You open up one of these books and they talk about dark cloud covers and piercing patterns and haramis and shooting stars. You think, do I need to remember all of these names and all of these patterns or candles? And you start thinking about changing time frames here too. Between the indicators and the names of candlesticks, analysis paralysis will set in pretty darn quick. So the goal is to simplify. Is it a big candle? Is it a little candle? Is it a bottoming tail bar? Is it a topping tail bar? Let's see if I can get a little drawing tool out here. Right, bottoming tail bars. We say buyers took control. It was a red bar. It went down and it came back up again. So as I look at an individual candle in a very simple way, I say, well, buyers took control. Now, we've got to add more to it. Where did it happen? What is the trend? What is the trend in multiple time frames? So when I look at an individual candle, is it big or is it small? Is it does it have a tail on it? Where's the location and the trend? Things start to come together. And the same thing, a green one that turns into a red one with a tail on the top, sellers took control. It's really simple. So what we think about is momentum. Is it increasing? Is it slowing down? Or is it reversing? And that is what you need to understand when you look at a candlestick. Sometimes they just flip it flopping around, going sideways, and the message there is just stay away. Nothing's going on. As traders, sometimes we have a hard time. The disciplines part is just staying away when there's nothing going on. So when we think about patterns, obviously they can form in a lot of different ways. So let's narrow this down to a few. And this is a simple pullback pattern, a retracement. And we say, well, at the green line, let's assume that that's support within an uptrend and it begins to reverse. That's a buy setup. A retest pattern. Sometimes the retracement gets a little deep, or there's a little bit more uncertainty in the stock or the broader markets, and they do a retest. And that retest creates a larger area of support or resistance. Flag patterns, right? Sometimes they call pendants or flags. And so prices move up with strong momentum. So you get multiple bars moving up in a fluid motion. And then they begin to slope downward a little bit as buyers come in and create new support or new resistance. And that's the essence of flags. Pendants may be a little bit more complex kind of a pattern where it goes up and down a little bit. But the essence of it is that it's creating an area of support after a momentum move, and that's bullish. And in theory, it's supposed to keep going up. The next question is within our thought process, well, up to where? Which will eventually get us to thinking about support and resistance. And there are basing patterns where prices go sideways. Now, is it going sideways in an uptrend? Is it going sideways in a downtrend? Is it going sideways at resistance? Is it going sideways after a run up like this? So it could form a flag or it could form a base. And bases after strong runs higher is what we buy breakouts. And after a big move down, we sell breakdowns. So these can form in a lot of different ways, probably in endless a number of ways. But as we understand the foundation and we use what I've coined bar by bar analysis, we put those bars, candles, in the context of support, resistance, and a trend, we don't have to know specific patterns per se, meaning you'll hear someone say that this pattern is called whatever it might be. There's got all these different names that people make up. It doesn't matter. When you understand the foundation or basics, well, you just put that, as I said, in the context of a trend, support, and resistance. Okay. So, question here, would you agree with me that this is an uptrend? Not a trick question. It's a yes or no, maybe, I don't know. Thank you, Jonathan. Thank you, TR. Yes, it's making higher highs and higher lows. Thank you, Jose, Andre. Higher highs and higher lows. Simple. Right? Now, has the trend been broken? I've kind of connected the dots. Has the trend broke? Yes, yes, I got a no. Got some yeses. Got more yeses than nos. Why has the trend been broken if it's still making higher highs and higher lows? This is what you're up against in this industry. It passed the line, TR says. Well, you created the line. Does that line that you connected points on a chart create support? TV line, but not a trend line. Well, it is a trend line, Mary Jo. I've connected the dots, right? And I projected it into the future. And now theoretically, that's supposed to become support. Now, after you're doing this for a while, you'll find out that a lot of lines get broken and it doesn't mean anything. Not a thing. Well, what does mean something? Well, when it breaks the prior low, it no longer meets the definition of higher highs and higher lows in an uptrend. So it's broken. And every time that happens, it will break the trend line. Every single time. Without a doubt, 100%, you can bet your life on it. Right? So as we remove the gray areas from our analysis by removing indicators, removing lines that were connecting dots, removing Fibonacci's, removing Elliott waves, you're going to be like the guy with the light bulb. And it's like, this is starting to make sense. It's really simple. Now, if I can just continue to follow this. So let's define support and resistance. I call it minor support, which is going to be what was resistance, the prior high. As it retraces to that, I'm going to call that minor support. And as it's making higher highs and higher lows, pullbacks into the area of minor support are typically where people are going to buy. If it goes all the way down to major support, the retracement is getting deep and puts the trend in question, but the trend is still up. in question, but up. If it breaks down below that prior low, just like the prior slide, it's no longer in an uptrend, black and white. Same thing in a downtrend, lower highs and lower lows. It breaks above major resistance, the high prior to the lower low. It's no longer in a downtrend. It's the start of a reversal. So we could call it a sideways trend, but we can't call it a downtrend. And we can't call it an uptrend yet because it's not in an uptrend yet. So now we're really getting down to defining things where it's really simple. Right? Resistance, when broken, becomes support, or supply becomes demand. Right? When you start thinking of resistance as supply and support as demand, the words start to become a bit more meaningful, because in a downtrend, when prices come up to resistance, there's supply, then we start applying candlesticks that tell us that sellers are taking control. So 7 points to mastering support and resistance. They're reference points or areas. It could be a base, it could be a swing high or low. And these prices move between these reference points that we call support and resistance. And buyers, whoever they are, institutions, prop traders, hedge funds, you and me, we buy at support because that's where the demand is. And we sell at resistance. Right? And this is where we look for reversals to form. So these areas of congestion that are above and below prices, or if they're really close together, whereas you're looking at highs and lows that are really close, that's choppy price action, right? So the markets have experienced that lately at different stages, either on a daily chart or an intraday chart, where you get these highs and lows that are close together and they chop around. Now, if we get sideways price action like the markets did 2 weeks ago when they came up to the top of the range and they went sideways, that was bullish. And if you go and look at the S&P 500, you'll see where it was in a trading range up and down. And 2 weeks ago, it went sideways there, and that was bullish because that resistance area where the supply was, sellers didn't step away. They actually began to buy again. And you'll see what I call a bottoming tail bar where it dipped down and it came back up. So there were buyers lurking below, and that demand pushed prices back up again. Same thing in a downtrend, prices go down, there's support, but they can't go up. That's bearish. Sell the breakdown. Now, gaps, momentum moves, what I call fluid moves, H bar going up, making higher high, higher low bars, create these voids. This was a big aha moment for me back in the early 90s when I looked at, well, why does this setup move up in such a fluid way with momentum and another one doesn't? Oh, there's nothing to the left. There was nothing to trade against, no place to put a buy order when something was in a downtrend or a sell order up above. And that's why traders like to buy stocks making 52-week highs. So let's try and simplify this a little bit more with what I call visual aids. These are moving averages. They're subjective, but I'm going to give you a systematic, objective way to use them. Right? So on a daily chart, I'm going to use a 20, a 50, and a 200. Simple moving averages, no exponential, no weighted, no optimized, just simple. You don't need to draw trend lines, just look to the left. And I said you're going to use moving averages as a visual aid. And we're going to put this 20-period moving average as a short moving average because it follows the trend relatively well. Right? So here's 3 charts, a 60-minute chart, a 15-minute chart, and a 5-minute chart. Would you agree they're all going in the same direction? Yes, right? No trick. They're all going up. So would you agree that the odds are on the long side with these multiple time frames in alignment? And theoretically, if we were to buy pullbacks to support after a bottoming tail bar, odds would be on our side. Sure, common sense. Now, are these going in the same direction? No trick questions. It's really simple. No, they're mixed, right? 60's going up. The 15 is flat to starting to turn down. And the 5-minute is in a downtrend. So they're out of alignment. But since the higher time frame is going up, maybe the lower time frames are going to turn around. We're just not sure yet. So how do we use this intelligently? By looking at these moving averages on one time frame. How do I calculate this to look at all of that and know what's going on in one time frame? So as I'm explaining here, you calculate the number of bars in a smaller time frame that make up a higher and multiply that by the moving average in the higher. Right? So don't think about it too much, just follow along. So let's just call them smart moving averages. And this is what you would do. 60-minute 20 MA is the same as a 240 on a 5. 12 bars times 20 equals 240. We're going to use the 200. 15-minute 20 MA on there. Same as a 60 period on a 5. 3 bars times 20 equals a 60 period moving average. No Fibonacci's, doesn't make any difference. I'm just giving you a way of knowing what's happening in one time frame by just looking at a smaller. So on the 5-minute, I'm going to look at a 20 MA, a 60 MA, and a 200 MA. And by doing that, I'm going to know what's happening on all of those time frames. Are they all going up? Are they all going down? Are they chopping back and forth all over the place, intertwined with each other? Going to make it pretty simple to know what's happening on all 3 time frames by looking at one. Right? So I like to start with the daily chart with a bias. And on that daily chart, upper right, I see that prices went down to an area of support. There's a bottoming tail bar. You see the star, and it started to go up. And on my 5-minute chart, you see the 3 moving averages, and the prices are above all 3 moving averages. So I know that in all 3 time frames, they're all trending higher without looking at the other. And you can, there's the 15, and there's the 60. So this consolidation on the 60 period moving average, right? You can see the wide range bar up and then the sideways price action supports a bias that if it breaks out, it should go higher. So as I'm looking at my 5-minute and I see my 3 moving averages and my bias for my daily, if it breaks out, the odds are on my side that it's going to continue to go higher. So I've cut down a lot of information to make things simple. So as I look at this, now I've taken the prices away. So we need a way of interpreting this. So if the moving averages are relatively close together, I know that the price action is relatively tight. Now, they don't always have to be for us to take a trade, whereas the 200 could be well above, but the 5 and the 15 time frames are pretty tight together. So one thing that we want to do is we always want, in a downtrend, we always want to be shorting near an area of price resistance and near the 20 MA, which we just need to look to the left to see if there's price resistance there. But when the time frames, the 60 and the 20 are close together and the prices are in the area next to them and there's a void below, 3 time frames facing down, the odds are in my favor. I know that for a fact. So there's no holy grail here, right? There's just common sense of saying, is prices going up, down, or sideways? Do I have multiple time frames going in the same direction? Is there anything to the left to stop them from continuing to go down? If that answers all my questions in the affirmative, well, then I should be going short with the appropriate candlestick pattern. So when I see this picture, I don't know what the heck's going on, and neither does anybody else, because prices are intersecting between all the moving averages and it's flip-flopping up and down, and you got big red bars and big red bars and green bars and tails. Just stay away. Don't trade it. Move on to something else. So here we have a daily chart where prices start to roll over. You can see the topping pattern. And now on the 5-minute chart, right? I call this directional afternoon trader, where my moving averages are relatively close together. My bias is that it's going to go down, so I sell it short, in this case, a breakdown. In this case, they're going up. Let's assume I've already looked at my daily chart. I've got my bias, and prices have gone up. And so now, what's to the left? Support. And support. Let's get the drawing thing out here. We got to go back and forth here to do this. So once it pulls back and reverses, I've got a reference point that I refer to as a pivot or a swing low. And when prices come down there again, and you can see they're in between the moving averages, that's okay. So on the 15-minute time frame, it's pulling back to the 20 on the 15, right? Same as the 60 in this time frame. And it's in an area of support. Once I get a reversal, I can buy that. And because all three time frames are up, I'm going to make an assumption that the trend, like you say, the trend is my friend. I'm going to make the assumption that it can get through this resistance area, right? When we trade, we make assumptions based on prices continuing a trend. Do we know it's going to happen? No. But we put the odds in our favor. That's the whole goal here with trading, is to put the odds in our favor. Right? Another pattern, right? We're looking for the same patterns. We're looking for alignment of multiple time frames, pullbacks to support. Get the drawing tool here. Pullbacks to support, pullbacks to the moving averages, and reversals. We look for continuation to go up. I guess everybody comes back to lunch. Why does it happen around 2 o'clock? The majority of times, it's just the way it is. We look for recurring patterns and setups. So time is another factor, right? In the morning, 10 o'clock, 10:30, in the afternoon, 2 o'clock, 2:15, and things tend to perk up again. Trying to get through my time here. Gaps. Gaps provide us with opportunities every day to go and look in a certain location, that particular stock, where something has happened. And so once I look at my gap list, I then look at my 5-minute chart. Are my time frames pointing up? And I'm always interested in, if our prices above yesterday's close, and are they above today's open? And if they're above these moving averages and they're above yesterday's close and today's open, my bias is that they're going to continue to go higher. Right? Retest pattern, bottoming tail, pullback pattern, bottoming tail. Everything's pointing up. And so just more examples of the same thing. Gap up. That gives me, go look here for my gap setup. Bottoming tail breakdowns. I like this kind of a pattern. It's a little shakeout. Why should a shakeout like this work? Because all time frames are pointing up. Pullback pattern. Some people call them a hook pattern. It's just a pullback, bottoming tail bar, green bar reversal. It should keep going up. And you look to the left and see what's over here, if anything. And within an uptrend, you assume that prices can take out resistance. Another example, same thing. Is it above yesterday's close? Is it above today's open? Is it in an uptrend? Are multiple time frames in an uptrend? Is there a retest pattern to buy? Is there a pullback pattern? Candlesticks, bottoming tail bars, green bars. Sometimes we look for red bars ignored. One of the concepts that we focus on. That just tells us that buyers continue to be in control. Right? Downtrend, right? Prices go up and they go down. If they're going down, I want 3 moving averages, prices underneath them. I want to be shorting near the 20 MA, near price resistance. I want them below today's open, below yesterday's close. Is it got room to drop? Are there topping tail candles? Sell short. Right? So scans. A lot of platforms have scans. Right? This is just what I use, TC2000. I created some scans, different, whether it's breakouts, breakdowns. This is gaps. Are they gapping above a big red bar, down below a big green bar, what I call shock patterns. And then on my 5-minute chart, same thing that I showed you. I'm interested in what the market's doing. So one of the factors is if the stock, I believe, is going to go up, is the market going up? Let me put that in my favor as well. Am I almost out of time here? I'll get done. I think so. And so I've been doing this over 25 years, folks. Myself trading, investing quite a bit longer, I guess, over 30 years or whatever. But I've been in the education business for about 25 or so years. Some of you probably know me from my old company. You probably hear some of my old students talking the same language as myself. So that would give you a clue that they're my students, but you can check it on the site. We've got tons of testimonials. And by the way, I didn't talk about our chat room, but you can check out the green room and visit with us for a week. But for free, you can come to YouTube, youtube.com/C/Master Trader. My partner and I do a pre-market review, what's happening in the broader markets, commodities, gappers and such every single day at 9 o'clock. We're on there, so you can check that out. Tomorrow, we'll also be doing tomorrow an MT Live on YouTube as well as in our chat room, which you can check out. And what I'm offering today is my swing trading course. You can check all of this out on the site. Monthly coaching sessions for life, which I'll be doing one next Tuesday at 4:15 with students. The gap trading course, which covers what between those two courses, everything and a heck of a lot more than what I covered today. You can get a month in the green room with us where there's education every single day and live trading. And I will share with you all of my scans in TC2000 if you're using that platform for nothing. So if you go to that website, mastertrader.com, precision trading, and geez, I thought I put the code in here. The coupon code is precision. And if you type precision into the coupon code there, it's going to reduce the price to $9.79. So there it is. I hope you learned a lot. They'll be giving you the recording, and you can review this again. And if you have questions on it, you're welcome to email myself, greg@mastertrader.com. Maybe you just want to check out the green room and for a week. And if you feel comfortable with what we're doing in there and what you've learned here today, I will consider extending this offer by emailing me.